Greetings. This video will be very quick. However, we want to cover one of the topics that comes up in all financial media and from all sorts of talking heads, and that is how Federal Reserve quantitative easing, money printing is about to cause hyperinflation, and the way to hedge against hyperinflation is gold, as well as silver and other precious metals. Now, as other videos on this channel have explained, that is wrong on two levels. One, quantitative easing does not cause any aberrantly high inflation unless it's above a very high level that still has not been breached. In the last 11 years, the world has done over $30 trillion of quantitative easing. And that includes about 11 trillion in the last 15 months since the start of the coronavirus pandemic. And that is not enough to cause high inflation because the world has technological deflation, and as technology converges to a higher and higher percentage of the world economy, the amount of deflation accelerates exponentially. And the amount of quantitative easing worldwide that has to be done just to offset this deflation is also therefore rising exponentially. I detail all of this in my Atom thesis, which many of you have read. If not, you should check it out. And from my calculations, I estimate that right now in 2021, the world can absorb about $400 billion a month of quantitative easing without any aberrant inflation. In fact, that is how much that has to be done just to offset technological deflation and maintain steady 2 to 3% inflation. Most commodities are still well below their all-time highs and have had net negative price trends for the last decade or so. So these are the reasons that people think printing money causes inflation, and at one time that was true, but that was in the pre-technological age. In the 1970s, too much liquidity caused inflation. But as technology has converged to a higher and higher percentage of the world economy, that script has been flipped and the default standing is towards deflation in the economy, if not for the money printing worldwide that offsets that deflation. So number one, the premise that there's going to be hyperinflation is wrong because all these inflation mongers have predicted 100 of the last 0 bouts of hyperinflation. As I said, $30 trillion has already been printed and commodity prices have been trending downwards over that same 10-year period. So for that reason, one should not have an investment thesis that is dependent on hedging against hyperinflation because, again, there's none of that. Now, the second misconception is that somehow gold, as well as silver and other precious metals, are the hedge that you need against hyperinflation. That is also false. That may have been somewhat true in the past when we were not in a high-tech economy and currencies could just collapse and things like that. But now that is a completely wrong-headed way of thinking. To believe that gold and silver are hedges against hyperinflation, even if there were to be hyperinflation, which there will not, as I explained, that presumes that nothing can increase the supply of gold and silver. And as we know, technology always increases the supply of any commodity that gets more expensive. The same people thought there would be peak oil. Remember, in 2011, 12, 13, peak oil was all the rage, and then oil prices collapsed around 2014 and 15 because oil supply increased and technology found a way to increase oil supply. Technology is also finding a way to reduce oil consumption, and that's why electric vehicles are spreading very quickly and becoming a larger and larger percentage of all new vehicle sales. The same can happen for all precious metals, gold, silver, etc. If they get too expensive, the profit that could be secured by anyone who increases the supply of any of these metals becomes more and more. Therefore, more people focus on that problem, and more investors also invest in the people focusing on that problem. And the reason this supply response happens so quickly now in 2021 relative to 30, 40, 50 years ago is because the technological medium of the world is much larger and more powerful and more dynamic. Therefore, these adaptations around any supply shortage or temporary price spike are very quick. In 1974, we had an oil spike and the technological medium of the world was not advanced enough to adapt around that. But in 2014, it was. And I even have a whole equation about how oil prices were doomed to fall, and I predicted that years in advance, as many of you know. The same applies to any commodity, certainly gold. Now here's the other problem. Any premise of scarcity as an investment thesis is also wrong because technology always finds a way to increase supply of anything that is too scarce. Now here's the other problem with any scarcity mentality approach to investment. That's just not resonant with the first principles of technology, because the first principles of technology are always about increasing supply and lowering costs of anything. And therefore the most profitable businesses of the modern age have been ones that have no supply scarcity. And by that I mean knowledge-based businesses. And software is the most obvious example, but you can also add semiconductor chips and even pharmaceuticals to that list. These are all businesses that are based entirely on knowledge and have no material supply constraints. Software takes up no material. Semiconductor chips take up very little material, and pharmaceuticals also take up no real raw material costs. It's entirely a knowledge-based product for the most part. And therefore all these most profitable businesses are very dematerialized. That's why gold, silver, and other precious metals as an investment thesis based on scarcity is just wrong-headed. Now if you look at this chart here that I have, you can see this phenomenon in action. The yellow line is the price of gold, and the blue line is the price of stocks. And we'll just take a few snapshots of long-term price trends. Over 10 years you can see gold did virtually nothing, while the stock market is up 180%. 30 years, same thing. The stock market did much better than gold. There were a few brief episodes where gold might have done a little bit better, but overall, stock market did much better than gold. And if you take all years, so this goes back over a century, the performance of the stock market is just higher. Now that doesn't mean you should enter the stock market now necessarily. Whenever you allocate heavily into one particular asset class, always do so in small increments so that you never risk buying too much at a bad price. But nonetheless, the stock market did much better than gold. And this makes sense because the stock market is full of companies that have people working at them that are trying to create better and better products and innovate and sell better products than their competitors, where gold is just an inert metal. There are many technologies trying to increase the supply of gold, from drones that can prospect more efficiently to asteroid mining. And while asteroid mining is not something that exists today, it is something that is going to exist within a decade or two. And when it even starts to become feasible, the price of all these precious metals will get revised downward because they are inert commodities. Now in this channel, I have made fun of a lot of relatively well-known finance and economics people who have all advocated that people buy gold just to hedge this imminent hyperinflation that never seems to arrive. I have videos that completely deconstruct the arguments posed by Peter Schiff, by Robert Kiyosaki, who makes some of the worst arguments of all. He says gold and silver are God's money. He tries to make a theological argument around it. And he also says he's been investing in gold and silver for about 45 or 50 years, but he never talks about the returns of them, which tells you everything you need to know. And even someone you may never have heard of before, but she's called Danielle DiMartino, and she says she's bold gold because gold is the way to hedge against inflation. So I have videos that are deconstructing the arguments of all three of these people, and notice that none of them actually talk about their investment returns and the returns of gold. Now one truly has to wonder why these people advocate an investment that does poorly when one simply looks at a chart of how it performed. Do they think no one should ever look at charts? They should just believe an argument that was memorized because it might have been true 100 years ago? Is that what you should base your investment thesis on? Always go to a chart like this one, and this chart will be in the description box below, and play around with it as you want. This is the performance difference between stocks and gold, and these are not even tech stocks. These are all stocks, of which tech stocks are only a small fraction. Technology-based stocks have done better than the rest of the stock market, and that decoupling should continue to happen as we go forward in time, even though that doesn't mean now is a good time to buy or anything like that. I'm not making any specific recommendation on timing or anything like that, for sure. Just use this information to come to your own conclusions and do the research to come to your own conclusions. I'm just trying to present how you should begin to research something and what information to tune out and what information to look for. But this video is necessary because all these gold bugs, all these people advocating gold, they never talk about returns. They never talk about returns at all. And that should leave you suspect. Anyone who advocates gold a lot by definition has not earned good returns and does not know how to generate good returns, because the proof is in the charts, the hard data. The data doesn't lie. So in closing, those are the 2 points. There is not going to be the hyperinflation that they keep saying is going to happen any day now. They've been saying that for 11 years. After $30 trillion of money printing, there is still no aberrant hyperinflation. There is, by contrast, the threat of deflation if the central banks of the world were to stop their money printing. They have to maintain about $400 billion a month and rising just to offset technological deflation, number one. And number two, even if there was high inflation, gold is not the way to hedge against that at all. Those are the takeaways. So I hope you found this video informative, and if you like this type of content, I urge you to subscribe to this channel. Thank you very much for watching.